So I had a one-to-one session recently. First time meeting this guy, right? And after we'd done that sort of polite bit, the getting to know each other bit, he just all of a sudden stops in his tracks and stares straight into the camera lens at me and goes, look, I'm 35 and I've got virtually nothing saved. I've enjoyed my life, no regrets, but I now want to get super serious. Just tell me what I need to do to get £1 million. So I was quite taken aback, but that is exactly what I did for him. And what you're about to watch is the actual plan, the step-by-step that we built in that call together to get him there. Quick thing on this first, there is an app that I use in every one of those sessions that I have with people where we run the numbers live, and it's the same one that I'll use to show all the maths in this video. It's in the description below. It's free, so you can pull it up and put in your figures as we go, so you can sort of play along as we go. Now, the first thing that we did, the very first thing we did, slightly caught him off guard, I think. It wasn't what he was expecting, because here's the truth that most people get completely backwards in my experience. You can have the cleverest investment and financial plan imaginable, the most polished setup on earth, but none of that matters if the fuel that powers that plan stops arriving. Building wealth leans almost entirely on you being able to keep funneling and feeding money into that machine, into that plan, month after month after month. So before you grow a single one of your pounds, you protect the thing that produces those pounds, your income. It's a bit like a fire, right? Think of it like a fire. We all get excited about how big we can make the flames, right? The returns, the growth, the compounding. But nobody stops to think about the wood, right? The fuel. Stop the wood and the fire is literally just a memory. So what did we do? We sorted income protection. Now, income protection is just an insurance policy, right? You pay monthly premiums, and if something like illness or injury ever stops you working, it kicks in and pays, roughly speaking, around 60% of your income until you're back on your feet. Yes, it was a monthly cost to him, but it's the part of any plan that just lets the rest of the plan exist. This is like no water's going to be flowing through your pipes if you don't have this. And then we moved on to something once we'd sorted that out that I think at this point he was starting to get a bit frustrated because he wanted to skip to the exciting stuff. He wanted to skip to the exciting bit of this plan. But the next bit mattered just as much as protecting his income. Look, you have all seen pretty beautiful compound growth charts just like this. The ones that beautifully curve up over time. But here's what they do not tell you. They only work if you literally never interrupt them. And the contributions keep coming in as they did every single month. And more importantly, that you never dip in and pull any money out from this equation. Think of it a bit like a snowball, right? You start rolling and you know that given a long enough hill, the snowball will end up enormous, right? We all know that analogy. But if every couple of months or so, you stop that snowball, stop, and you scoop a little handful of snow out and then set it rolling again, it's never going to reach the size that it could have. Every withdrawal, every demand on your fund is a handful of snow gone for good, essentially. That is why the very next job that we did was to set up an emergency fund. Now, the textbook says 3 to 6 months of cash sitting there to replace 3 to 6 months worth of expenses, right? But this was interesting because the guy that I was talking to actually knew his way around money. He knew how to handle it. It was quite strange. Just because he had no wealth yet, it doesn't mean that he didn't understand it. So I actually felt pretty comfortable sharing with him and showing something that I really, really don't raise with a lot of people. And it's something that for most people, they should absolutely steer clear of. But instead of a big pile of cash, 6 months of expenses, doing very little apart from the fact that it's emergency fund, just a big bloated emergency fund. What he did is he kept maybe 1 or 2 months of cash in actual cash, and then lined up about 18 months worth of all the time of rolling interest-free credit cards as a standby facility. He was saying that like he would rather his own money was out there working than sitting idle. Now, obviously it's not sitting idle. It's, you know, it's got a role. It's an emergency fund for most people, but he just wanted it slightly different. Now, look, that truly is not for everyone. And for the most people, you should just go with the textbook answer. But that works if you're willing and genuinely able to trust yourself with a credit card. And plenty of us know, hand on heart, that we don't trust ourselves. But used properly, this is quite the advantage. This is how I run my money. What I do is I let the bank's money sit on standby while yours and mine has a job to get on with. That's the most important part. Right, now the good bit. How we actually build the million now that we've got all those base level things put together. At this point, it is just simple arithmetic. The equation has pretty much 3 moving parts. How much you put in each month, the rate of return that you get, and time. That is it. Those 3 things absolutely decide where you land in future. So the key thing is we had our target, right? He wanted £1 million. So the next question was when? And when matters because it absolutely drives everything else. Now, this guy was on a decent salary. I think he was earning about £70,000. So there was enough ammunition. There was something to work with. But once we ran the initial sort of back of a fag packet calculations, getting to £1 million in the next like 5 or 10 years just wasn't realistic. Obviously, he'd have had to put away way more money than he could ever afford. So given the fact that he was 35, I was sitting there thinking, well, it's obvious, really. You need to be focusing on your pension. So I pointed him towards the notion of using a pension instead, because that is the route, as you'll see, with the absolute least friction. And at age 35, he wasn't actually all that far away from the age that you can actually access your pension, which right now, of course, is 57. So he goes, like, we were talking about the accessibility and the pension stuff and the, you know, the advantages and disadvantages, all this sort of stuff. And he was like, right, okay, can't access that until I'm 57. He goes, honestly, I can't afford to retire before 57 anyway, and I don't really have any ambition to do so. I'm happy to work towards that. And I'm sat there like, perfect, because it was the one decision that just unlocked the whole thing. And it was his workplace pension as a vehicle. Look, the absolute key thing here is that building wealth is never really about what you earn. It's about how little of it leaks away on the journey. If you cut the tax friction, what you earn finally becomes what you keep. So anyway, we pull up the Forecaster app. So remember, links in the description if you haven't grabbed it and not looking at it yet. And here's the interesting part. He'd actually done quite a lot of research into investing and growing his money before our one-to-one session. And he'd actually gone so far as to actually pick an investment fund, or an ETF it was, that he liked and wanted to invest into. And I was like, fair enough. We looked at it in the call and look, it was a good fund. It was well diversified. It was sensible, but it leaned quite defensive, which was surprising at the time, to be honest. Here's what I mean. When you invest, you can put your money into different things, right? Different asset classes. And generally speaking, there are pretty much 2 main ones that people go on about. Okay, you have equities, which is the stock market, stocks and shares. Now, this is where pretty much all of the long-term inflation-proof growth lives. Historically, you'll get something like 8% a year on average. The trade-off, though, is the ride. it's volatile as hell. And in a bad spell, you can see your money go down by 30, or even worse, in 2008, went down by 50%. Now, bonds, on the other hand, are loans to companies and governments, where you loan your money to companies or governments. Now, these are far steadier, right? The swings might well be 10 or 15% absolute worst. We've just seen 2022 as well, the worst year for bonds ever, really, since I've been doing this job. So it's kind of more so along the lines of like 5 to 10% volatility. Anyway, but the long-term return, the trade-off, is a lot lower, maybe 4, 5, 6% a year. So as you can see, it's all about the trade-off between volatility and return. That is it. Now, the fund that he was looking at, that he wanted to invest into, was forecast to grow about 6% a year, had a blend of stocks and bonds. Now, that's not bad at all. But the problem is, starting from zero, 6% meant that he needed to contribute £2,000 a month to hit his £1 million by 57. So what I did is I floated the concept of leaning further into equities, more in the stock market, right? Higher expected return, but yeah, a bumpier road. But bumpier roads barely mattered here, because we were looking at a 20-year time horizon. So long. Over that long, short-term volatility in the stock market just washes out. Over decades, all of that volatility washes out, and equities will massively outpace bonds. Like, think of it this way. Say you are flying from like London to New York, right? You get on that plane and you know near enough that you'll land in New York perfectly fine. That doesn't mean that there won't be like little patches of turbulence somewhere over the Atlantic. But the turbulence isn't like the journey, is it? It's just a few uncomfortable minutes on an otherwise safe trip. That is a great representation of the stock market over the long haul. So if you can tolerate those short-term ups and downs, you want to be flying. So what we did is we found him an option averaging around 8% a year. Now, of course, that's all speculation and it's not guaranteed or anything like that, but I have to admit it's probably a fair long-term expectation. Now we had 2 of the 3 essentially levers sorted: time and the return. So the forecaster spits out the third. Starting from zero, 8% a year compounded, to reach £1 million at 57, he needed not £2,000, but £1,500 a month. And then when I actually showed him this and we went through the actual numbers, I could sort of see the colour draining out of his face. I watched his face kind of go a little bit like, oof, that's a little bit more than I was hoping. Like, I don't know what he was expecting, but it wasn't that. He was still talking about, yeah, look, I'm serious, but I still want to enjoy today a little bit, not just shovel everything into my future you. But in all fairness to him, he goes, look, I'm serious about this whole thing, so let's get on with it. Let's figure out a plan. And this is the part that flips the whole story. So I turn to him and I go, okay, so you personally do not need to find £1,500 a month. What if your employer and the government covered most of it for you? And he was just like, what are you talking about? He didn't believe me. But the reality is that's completely true. And it's the bit that most people usually overlook. Because we'd already agreed that he was able to leave his money until 57, that is exactly why this all works so well. If he was funding the £1,500 a month from his take-home pay, the amount of money that lands in his bank account every single month, into, say, something like a stocks and shares ISA, that is £1,500 of real money, his money, leaving his bank account every month. But through salary sacrifice into his workplace pension, the £1,500 gets assembled in 3 pieces in sort of 3 different tranches. His employer chipped in 3% of his salary. That's employer matching. So in this case, that was £175. Then he was having to sacrifice £1,325 a month of his, key phrase, gross salary. But that's the point, right? That's money that would have been taxed at 40%, plus of course 2% for national insurance. So the tax relief element to him was £556.50, which means that his actual take-home pay, the bit that lands in his bank account, by doing this £1,500, only reduced by £768.50. That is what he actually had as the difference between his take-home pay before and his take-home pay afterwards. Now, if you add up all of that, £768 from him, £556 from the taxpayer, £175 from his employer, £1,500. Just sit with that for a second. He didn't need to scrabble around and find £1,500 every single month. He only needed £768. The rest was funded by the taxman and his employer. Now, I can already hear you already screaming already, and maybe even you've typed a comment, but the elephant in the room here, a pension does get taxed when you draw money out in the long run. But for most people, the math still absolutely wins easily. So what happens is you get tax relief as a typically higher rate taxpayer on the way in when you put money into a pension. And usually by the time that you withdraw it, you're typically a lower taxpayer. So sort of that tax arbitrage, and you get 25% of that pension tax-free anyway. The relief going in plus decades of free compounding, tax-free compounding, comfortably outweighs the tax differential coming out, especially if you are clever about how you take it out on the back end, because you can be, and that's basically a lot of what I do with my clients. So here's where he actually is going to end up. And here's how he is going to get his £1 million. Over 22 years, over the next 22 years, £1,500 a month adds up to $396,000 going in. That's the contributions that have gone in. But remember, only around £203,000 of that is his own money, the money that he'd have to sacrifice that he could spend on other things. His employer puts in roughly £46,000 over that time frame, and tax and national insurance relief adds about another £147,000. And of course, you can see here that growth compounding over that 22 years does all of the heavy lifting, almost near £604,000. You do not need to earn and save £1 million. You just need 768 quid a month and a bit of time. Crazy. Now, the topic of pensions is absolutely critical, and I'm hoping from this video that you can see the absolute power that they have. But I've got to be honest with you, there is one setting, one option that is quietly probably turned on and existing within most people's workplace pension that is absolutely destroying any of all of this that we've just talked about and preventing it from happening. Which is why, honestly, I really think you should watch this video here next, because I'm going to outline the whole thing and give you everything you need to do something about it, to do something about shifting your future growth. So give it a click and I will see you there.